because it reached a target. If you get a bearish candlestick signal at a target, then we can think about it. And just an example here. Here's normally an ascending triangle normally happens during a rally, but doesn't always need to be that way. An ascending triangle is the market is trading horizontally, you have higher lows. And when is an ascending triangle confirmed? How do you know when is it an ascending triangle? When the market breaks out of it. Okay, it's building one, but it's not confirmed until the market closes above it. And you could just take your measured move from the ascending triangle. Okay. Again, box range is one of my favorite measuring techniques. Okay, so in other words, here the market broke under the support level. By the way, as soon as it broke support, what became resistance? That's what. So this is getting back to Sharish's did I pronounce it? Question. You know, he was talking about a resistance level. When it breaks resistance, do you wait for a pullback? I said no. If it breaks a resistance area, we would be buying it. The price we'd say we're wrong is if it comes back below the support area. Same thing here. As soon as the market closed below the support area, short, the price, there's always a price that says I'm wrong. The price that says I'm wrong is old support should become resistance. If the market closes above that, we're wrong. And actually, more than wrong, because it would be one of those crack and snaps. That would actually be bullish. But I would be short on that with a stop-out level above that horizontal line, the bottom red line. And what we do is we take the height of the range as a potential target. Yes?
So Steve, on this pattern, if you had gotten a failure on the downside of it, cracked, went back up.
Right. The question is if we had a failure and it moved back up.
Would you reverse the trade and go long?
Okay. The question is, would we reverse the trade and go long? If you have enough psychological wherewithal to say, I'm short, I'm wrong, I'm going to go long, yes. So we're continuing now with head and shoulder, Western technicals. Here we have head and shoulders. So once the market breaks under the neckline, it becomes a potential sell signal. So once the neckline is broken, it's a bearish signal. And by the way, in Japan, the head and shoulders is called the three Buddha pattern. And that's because in Buddhist temples, you have a large central Buddha. And on either side, you have two smaller Buddhas or saints. And this was around in the 1700s in Japan. And the head and shoulders was around in the 1920s in the US. And just shows how universal and timeless emotions are. And that's what technicals measure. Okay? Fear, greed, hope. There's a wonderful quote I had, and this is just, not from a Japanese source, but just to show you the universality and the timelessness of emotions. The world is too big for us. There's too much going on, too many crimes, too much violence and excitement. Okay, try as you will, you'll get behind in the race in spite of yourself. It's incessant strain. You try to keep pace and you lose ground. Science and all those discoveries move on you so fast that you stagger beneath them in hopeless bewilderment. The political world seems so rapidly changing that you're out of breath trying to keep up with it. Everything is high pressure. Human nature cannot endure much more. This was written in 1833. Has anything changed? Isn't that amazing? So human nature, timeless, and this is why we have the same pattern emerge in Japan as in the West, because technicals gauge the emotionalism of the market. Fear, greed, hope, they're all reflected in the charts. So here we happen to have an inverted head and shoulders, and I want to show you these because it shows how you can use Western technicals on a candlestick chart for measurements. This one, that measurement, I probably would be totally out of long positions on that measured move. Why? It may be a little hard to see on the screen, maybe a little easier in your handout. What did we get at the measured move? Okay, so the measured move is the blue vertical line. It looks like in April. The opposite of the piercing. The dark cloud cover, right. I wouldn't go short, okay, because it's not really confirming resistance, but I certainly would take profits. Okay, here we have a bear flag, which was confirmed when the market broke, or bear pennant. Now, this is interesting. Here, like in the prior slide, we have the dark cloud cover confirming a target. And here, the same thing. We had a target with a bear flag. Essentially, what you do is to take the height of what's called the flagpole, and you take that from the bottom end of the trading range of the pennant. This is actually a bear pennant. If it's triangular, it's called a pennant. And if it's like a parallelogram or rectangle, it's called a flag. And the target is shown by the blue dashed line. And right at the target, in that red square, what I've done is I'm going to blow up that red square because it's a little hard to see. But in that red square is a piercing pattern. You see that vertical blue line is showing us where the target is. I just expanded. So what I've done is I've expanded this red square into this to show you the piercing pattern. Okay. Why would you, in spite of the piercing pattern, I would definitely consider taking profits there. Why would you not be going long? Think about the change of polarity. Right, the change of polarity. See how it broke under a support area? Old support should become new resistance. Once it got above that old resistance, you actually had a crack and snap. I don't know if it ultimately got to the top end of the range, but. Oscillators. Okay, this is really not an intense course on Western technicals, but I know many of you use oscillators, so I wanted to make sure I touch on it. And an oscillator is mathematically derived and includes RSI, stochastics, and so forth. And it's very objective. Okay, there are specific numbers. They were mathematically derived, so there's no room for subjectivity as far as the numbers are concerned. How you interpret oscillators, there is some subjectivity. Okay, separate from the price action. So for those new to oscillators, you're going to have the price on the top and the oscillator on the bottom. And oscillators really should, most people don't remember this, but oscillators really should be used in lateral markets. You should not have strongly trending markets. We'll look at an example of this in a couple of minutes. People forget about that. And includes these oscillators, stochastics, RSI, the MACD. The etc. oscillator is very rare. How many use oscillators here? Okay. This will be interesting. How many use RSI? Okay. Stochastics? Okay. Both of them? Wrong. You shouldn't. You should not use the same. You should use one oscillator because you're going to totally confuse yourself. You should be using, when you're trading, again, this is a different course than what I'm teaching here, but when you're trading, you should be using independent information, right, for lack of a better word. You should be not using 2 or 3 oscillators. You should be using something